All right, hello and welcome traders. Today I'm going to tell you why I hate the wheel. And then I'm going to tell you how I trade it. Okay, so it sounds like an oxymoron there. Let me jump into it and explain it a little bit more in depth to you. And first, we're going to jump in and talk about the wheel and some of the pros and cons. And then I'll show you how I would prefer to trade it if I traded it, which I don't currently really trade. I have a little different twist on it, but let me just go in and explain the wheel. So, and this is some trading that we have in our Discord as well, where the wheel trading is a method that, when executed correctly, can offer you great consistent income generation, but it comes with a lot of inherent risks and drawbacks, in my opinion. So let's dive deeper into it. First off, just what is the wheel? So the wheel strategy is a systematic way of generating consistent income by selling options and using the premium collected as either an income source or a basis reduction tool. For most people, it's an income source. The only time you say anyone ever tells me it's a basis reduction tool is because the stock or the asset's dropping and they collected some premium. They said, well, I'm reducing my basis at least. Okay. The only time people tell me they're reducing their cost basis is when they're losing. Okay. When they're winning, it's premium collection. It's great. Okay. Well, how do you do it? We start by selling a put in an underlying that we're comfortable with. Then if we get assigned because the market's dropping and that asset's dropping in price and it gets below the cost of that put, okay, or what we sold that put at, as soon as the price drops below, they're going to make us, take control of that stock at that lower price. Yay, we get to keep the premium. Boo, we get a stock that's declining. And then what we do is then we start selling covered calls against it, collecting some premium, and we wait until the stock maybe rises up, hits that covered call premium at some point down the road. And if it does, they take our shares away and we can start over again. Right? But if that put expires worthless, okay, then we can repeat the process over and over again until the call options are assigned. Now, I sell naked puts. I love to sell naked puts. The core of everything that I do involves selling naked puts and then maybe some other things with it. Okay. But the core of everything that we do and I do as a premium seller is I'm selling puts. Okay. I'm selling naked puts. Okay. And I love to do that. What I don't love is I don't really love assignment. Okay. I'm not afraid of it. I'll do it, but I don't really want it. Okay. That's not the goal. I don't want to own any of this crap. If it's going down, I don't want to be in something that's going down. Okay. Would you, if somebody was trying to sell you a title on the Titanic, okay, but you didn't want it, okay, and then it hits an iceberg and it starts to go down, and then you decide, you know what, I really want it now because it's going down and it's going to be great. Okay, I'm going to get paid more for this Titanic. The Titanic is sinking and it's not going to stop. Okay, why do you want to own the Titanic anyway? So the goal of the strategy is to collect premium and to potentially also collect dividends on the stock if you're assigned. That's a great bonus there. We can also call it the triple income strategy due to the opportunity to not only collect dividends when you own the stock, but you get the appreciation potentially of the assigned stock or option as it rises, and then you get the premium of the covered calls and maybe a little bit of that premium on the initial puts that you sold. So triple, maybe quadruple income strategy here. Sounds great, doesn't it? Yeah. So let's talk about how great the wheel really is. You can, regular income through premium collection is the first pro here. One of the most attractive aspects of the wheel is the ability to generate a steady income stream, right? Which is great. By selling a call and put options, you get to collect premiums that hopefully potentially accumulate and become a significant amount of money over time. Okay. Love it. Okay. Premium collection, selling premium. This is right up my alley. I'm a theta trader. I want to sell premium. This sounds great. Risk management. So relative to many speculative strategies, the wheel is considered lower risk, maybe, especially if implemented with stocks that the trader's willing to own for the long term. I am a trader. I am not an investor. I don't like to own anything for the long term. I don't own a single stock in any portfolio that I have. Not my IRAs, not in my trading accounts, not in my family's IRAs. No one in my family or my direct lineage owns a stock in anything. Okay. However, if you really want to own something for the long term, fantastic. Okay. This is because any potential stock assignments are part of the strategy. hey, we're okay getting assigned. You're only okay getting assigned because the trade went the wrong way. Okay? But now you're okay with it. So this one, it's still a pro. We'll keep going. Enhanced entry points for stock positions. Strategy can be used to enter stock positions at a more favorable price than the outright purchase. So by selling put options, you're potentially getting a chance to buy the stock at a discount if that option gets assigned. Okay, this one I do like. If I was going to buy a stock and I believe in that stock and I sell put options and I happen to get assigned the stock, well, I'd rather get assigned if the stock is at 200 and I sell a 190 put and the stock drops to 190. Well, I could have bought it at 200. I should be happier at 190. Why does that feel like I'm not so happy sometimes? Mainly because the stock's falling because you got assigned. Anyway, it's a great way to get into a stock. So if you're Warren Buffett and you want to get into stock, you start selling gigantic put options on that so that you can buy the stock that you wanted to own for the long term. If this is an investment, not a trading account, but an investment account, and your goal is to own stocks in fantastic dividend paying companies that appreciate over the long term, love this strategy. So I love it. Sounds great. Enhanced entry points. Let's keep going. Consistent and repeatable. Oh, that's speaking my language, man. I love mechanical, consistent, and repeatable strategies. I love it. Okay, let's talk about this. So once mastered, this offers a systematic approach to options trading. Like the word systematic, it's getting me excited. Okay, it can be repeated across different stocks and market conditions, providing a consistent method for traders. Traders. So this was for investing. I guess you can do it for both, huh? Okay. Consistent and repeatable. I love it. It's something that you can mechanically do over and over and over. You get assigned, you own the stock or the option or the futures or whatever, and then you write calls against it. And you just keep doing that every so often until it eventually gets up to that point. Great. Love mechanical, repeatable strategies. To me, that makes it somewhat simple. Okay. Control and decision making. Each stage of the wheel allows the trader to make decisions based on the current market conditions, offering a high degree of control over the process, and it requires little technical analysis. I don't know if that's a pro. Okay? They're telling me that I can make some decisions based upon what the market's doing. Maybe I'm going to sell. It's the stock's starting to move up. I'm going to sell higher, farther away, which means I'm not going to make that much money. And if it goes up, it's going to get tagged, but I can make different decisions. I don't really need a lot of genius technical here. Are the moving averages moving up? Yep. Okay. Did it pull back a little bit to one of the moving averages and bounce? Yes. Bingo. Let's get in. Okay. I don't need to do a whole lot of anything. I don't need to look at all kinds of Williams percent, RSIs, MACDs, which are all my favorites, by the way. I don't need to look at any of those. I really just need to look at some moving averages. And are we in an uptrend? Yeah. Did we pull back to one of the key moving averages and bounce? Yeah. Okay. Sell it. I want in. Okay. So I think you can use a little technical analysis to make some decisions. And then the last thing here, it's scalable. Okay. I do love this. I love the fact that it's scalable. I can do the wheel strategy in any size account. I can do it with a small, tiny, couple $1,000 account. I can do it with $100,000 account, $1 million account, $20 million accounts. I can do the wheel anywhere, okay, which makes it pretty flexible for me. So I like the pros. Sounds great. Let's talk about some of the cons of the wheel. Okay, number one, high capital requirements. To effectively implement the wheel, a substantial amount of capital is required. Just because you need to be financially prepared to be able to purchase the shares if you get assigned. That can represent a significant investment. Because every option you sell, if it's on a stock, it's 100 shares of stock. Okay. If it's on futures, it's just one futures contract per option, but still, it's going to require some decent amount of money if I get assigned. So if I'm going to sell it, I'm going to get assigned on 100 shares of Microsoft, and we know Microsoft's trading at 415. You better have $41,000 in cash in an IRA, or at least, $20,000 in cash in your Reg T account. Okay. Reg T IRAs, it's going to be a high capital requirement if you're going to get assigned on certain stocks. And one of the things I didn't put on here is, well, what if I just trade cheap stocks like 5 and 10? What if I just do this on Palantir and I do this on SoFi? Okay. Those are just fractionally more than penny stocks. Those are, SoFi sitting at $6 or $7. Okay. It's not, you're not talking about it, you're talking about a stock that goes to 10, okay, and then you write a 7 covered call or a 7 put, and you get assigned at 7, and then it goes down to 6, and you get assigned. Well, if you're a Tesla and you're watching Tesla, and if we pulled up the chart on Tesla here, and I'm looking at Tesla, what if I sold the 250? Well, I got assigned on that one. Well, I'll wait till the pullback maybe gets to 240. So I sold the 240. Well, it's down to 188, okay, from 260. Okay. How's your Tesla now? Okay. Still enjoying the wheel? Okay. High capital requirements. You got to be able to buy the stock if it's put to you. Number 2, potential for substantial price depreciation. Okay. I don't like the word stock depreciation. I'm actually going to change that to price right in here right now because I don't like the word stock because I don't like stocks. So a major risk is the possibility of a significant decline in the asset's value. If the market price drops below the strike price of my put option, I'm going to end up owning the stock. But I'm going to own a stock that's worth less than what I paid for it, which is no bueno, okay? And the asset's downtrending. The only reason you've been assigned is that the asset is going down in value. I always thought you were supposed to buy low and sell high, not buy low and sell lower, okay? Why do you want a stock that's downtrending? If the stock is downtrending, why do you want to own it? Okay. I'll keep going. All right, next one, opportunity cost and capital tying. Holding a position after assignment can tie up capital that could have been used for other investments. This opportunity cost, especially in a declining market, can be a significant disadvantage. Okay. I'm a trader. I am not an investor. Now, there's a complete difference here. If you're an investor, if you're Warren Buffett, buying the wheel's a beautiful thing. We just talked about the pros of it. Okay. I can buy stocks that I love, dividend paying, high quality stocks, buy stocks and stuff that I love. Cheaper. I was going to buy it anyway. I'll get some premium while I do it. Okay. I'm a trader. I could put Microsoft shares at $410. I could put Tesla shares at $188. I'm out a ton of money. Okay. If I wanted to buy Tesla right now, let's take a look. I can't really, if I bounce around, it'll be too much. But if I wanted to buy Tesla shares in my little Reg T account here, okay, 100 shares of Tesla is going to cost me $9,300. Okay. I can do a lot of damage trading with $9,300, but I can't now because I'm stuck with Tesla that's going down. Okay. Opportunity costs, I can't use that money. I have to wheel out of it. If I try to bail, I'm going to lose money because you got assigned on a downtrending stock. Opportunity costs. I don't like tying up my capital in something that could take forever to recover. Okay. Active management, time commitment. Now, we just talked here up here about control and decision making a bit, but active management, time commitment, unlike passive strategies, the wheel can require constant monitoring of market conditions and asset performance. It can also be time consuming and requires a certain level of dedication and expertise. I don't know that it's the most time consuming type of trade out there. I don't know that it needs to be. If you're willing to accept assignment, fine. However, if you don't want your shares to disappear and be taken away, you may want to be rolling calls now and actively managing this thing. Are you going to roll your puts out? You're going to close your puts early. So there's a decent amount of management there. It's not the worst thing for this. So I wouldn't consider it an absolute no. Capped profit potential. Ding, 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 ding. That is the number one biggest problem I have here. The profits from the strategy are limited to the premiums you received from selling the call options. Okay. So in a scenario where the stock price rises significantly, it can exceed that call strike price, okay, which is where the profit's capped. Okay. I sell Tesla's at 188. I get assigned at 185 or something. It's at 188. I sell the 195. If it gets to 195, I'm going to have to give up my shares at 195. If Tesla keeps going to 220, it doesn't really matter. Okay. All I will ever make is the little bit of premium, okay, that I got from selling the call. Okay. Might be a decent amount of premium, but it's typically not, gallons. Okay. Here, it's a bit of premium, and maybe there's some price appreciation depending on how you run the wheel. Okay. I don't like it. So you fully participate in the downside. If this thing's going down, you're going to be selling calls at the price that you were assigned, in most cases, not lower. Why would you sell a call lower than the price you were assigned and get called out and take a loss on the stock? Seems pretty stupid to me. Okay. So the farther this thing goes from the price that I was assigned at, the smaller that little premium is going to be until it's like nothingness, it's a couple cents. Okay. But my asset's just continuing to fall and drop in value. Tesla is going from 260 to 200 to 220, or I'm sorry, to 180, something, it's going 170 something. Okay. Tesla's been going down 50 points. Okay. I own 100 shares at a minimum of Tesla going down 50, 60, 70 points, okay, times 100. Okay. I'm losing thousands and thousands and thousands of dollars, and I'm selling calls way up here at my assigned price, making zero money. Okay. I'm making almost nothing on that. So you fully participate in the losses and you cap your gains. It doesn't seem like a great strategy to me. That's my biggest problem. Okay. Next thing here is complexity for novices. For beginners in options trading, the wheel strategy can be complex and daunting. It requires a good understanding of options, stocks, and market dynamics to be effective. I know a lot of people start with this. Okay. The wheel, easiest strategy. I don't know if it's the easiest strategy. I think it's the most dangerous beginning strategy because your losses can be unlimited. Okay. I don't like beginners doing anything where the losses can be unlimited. If you're a beginner, credit spreads, okay, defined risk trades, okay, anything like that and I have a stop loss potentially. Anything that gives me a stop loss or defined risk, to me, is a much safer trade. Okay. There is no limit to how far down your stock can go. Okay. So is it hard and complex? No, but what happens for most newbie traders and most new people seeing the wheel? And if you just type in the wheel, you're going to see 900 people saying 10% a month, 10% a month. I saw somebody today doing a YouTube video telling people how they can retire on like $200,000 or something because they can generate $20,000 a month or something using the wheel. It's insane. Okay. Stop. Okay. This is what's killing everybody. All these furrows out there talking about 10% gains a month. Can it be done? 100% you can probably do it. What kind of risk are you taking, okay, to get into these stocks that you're going to be wheeling for 10% a month? Okay. Now, I'm not saying it's not a good strategy here, but it's really not a good strategy here. Okay. I'm not saying that it's a totally bad strategy either, but I think you really have to be realistic and understand what you're doing. Okay. Most people are going to get sucked in by someone that's claiming 10% returns a month, 20%, 100% a year. Okay. I'm just trying to eke out my 1.5% to 3%, 1.5% in my IRAs and 3% in my trading account a month. And if I can hit that, I'm a pretty happy camper. 10%. The amount of risk that I would have to take in an account, okay, to hit 10% to me is just not worth it. Okay. Most people are going to get sucked in, and you're going to end up with low quality stocks because if you're going to make 10% on something, it's going to be a volatile stock, okay, that's going to probably get you killed at some point. In a bull market, you're going to look like an absolute hero, and everyone's going to post their 10% gains, and all of these wheel Facebook groups are going to go bananas. Okay. Then when you have 2022, it will wipe out everybody in that group, and now the group has 5 people in it. Okay. Last thing here is market conditions. The success of this strategy can be heavily influenced by the market conditions. In a highly volatile market, the risks of assignment increase, and the strategy might require more active management and can achieve large losses, okay, in that falling underlying. Bottom line here is the wheel allows you to fully participate in an asset's losses in a downtrend while it caps your gains in any kind of an uptrend. That doesn't sound like a great strategy to me, to have unlimited losses and cap my ability to make the money back or make gains. Okay. To me, though, it's a trading strategy, not an investing strategy at this point. However, if you want to turn this into a investing strategy, I like it a little bit better. But as a trading strategy, you can participate in these losses a lot more and see a lot more damage. As an investing strategy, you're typically safer, longer term stocks that you're okay being in for a long time. I think that makes the wheel much more effective. Don't like it as a trading strategy. I like it as an investing strategy. Okay. So a couple of my rules for wheel in here. Okay. I only sell puts on underlyings that I'm truly okay holding. Everyone says that. Okay. Do you really want Palantir and SoFi and Roku, maybe, and AMC, and who knows who else? You can think of any of the meme stocks out there. Do you really want those as long-term holdings in your portfolio? Oh yeah, me. Great. Okay, then get out. This is not for you. Okay, you can go and sell the wheel and do those types of stocks. Okay, but don't come back to me after you've taken a gigantic loss on those. Don't chase high premiums. Just because you can get a 10% return on selling calls and puts doesn't mean you should. That means the underlying is extremely volatile and it's going to potentially burn you, potentially. Okay, for a while, you're going to make good money. I'm sure of it. Okay. Don't sell calls. Rule number 3, don't sell calls below your assigned strike price, locking in a loss. You get assigned at 190, don't be selling 185 put calls. Okay, you got to sell 190 calls. You can sell that right at the strike you're assigned, that's fine, or maybe slightly higher, okay, but don't sell below and lock in a loss. And we didn't go into this thing like, but I made 6% on my puts. I'm okay taking a 3% loss on my calls and getting called away. Now you got a 3% return. Now, if it's in a month, okay, maybe. But that was a lot of work and a lot of hassle to make 3%. Okay, but because I thought it was going to be 10% a month. Okay, often low beta and dividend paying assets can provide the best longer term wheel of trades. Number 5, never risk more than 10% of your portfolio on any one underlying. Don't go in, because you're going to get assigned 100 shares per contract. Don't go in and now get assigned on 200 shares of Microsoft, and now you're over what? What's the margin on Microsoft here? In just a Reg T account, we'll look at the Reg T account. If I wanted to buy 200 shares of Microsoft, it's going to cost me, $42,000 in a Reg T account, I believe. Okay, so $42,000. Okay, you get assigned 2 shares, 2 contracts, okay, of Microsoft, $42,000 of use in your account. I don't think that's exactly where I want to be, right? So just be aware that if that's more than 10% of your account, don't be doing it. Oh, I'll just wheel, and no, don't do it. It's too big. Understand that you might be assigned shares of the put at any time and that you would need to cover the cost of owning those shares. So just make sure you understand that somebody doesn't have to wait until the day of expiration to assign those shares to you. Somebody might put those shares to you early, or they may call them away early, which would be probably good. But getting assigned, maybe you don't want to get assigned at that price, but you sold it. You shouldn't be selling prices that you don't want to get assigned on, but you could get assigned early. And then the last thing here, selling puts on a daily pullback during a weekly uptrend can increase the probability of success. So if I'm going to do it, that's how I want to set this thing up. All right, so all that being said, here's how I trade it. And I really don't trade the wheel hardly at all or often, but these are you got my rules. I will go through my strategy of trading the wheel. And you're going to think, that I'm just some boring old guy, that isn't going to make a ton of money. Well, if I'm going to do it, I'm going to do it right, and I'm going to do it on the right types of stocks. And you know what? Let's even pick a stock out there, and we'll see if anything meets my criteria. Give me a second and see if we can pick a stock before I go through the how I trade it, because maybe, just maybe, we can find a stock that we like. All right, you know what? I hate to do that, but let's take a look at. Let's take a look at McDonald's. All right, let's take a look at McDonald's. So we're gonna put a trade on. I have not even looked at this. I have no idea how this is going to work out. I'll even need to get a scrap sheet of paper here so I can make some notes because I didn't really plan for a particular stock. So this is how I would trade it. Okay, I want to possibly own the underlying for about 6 to 12 months or more. So I'm really not going to get into something, okay, unless, okay, I'm willing to own that for at least 6 to 12 months or potentially more. If you don't want to own your little high flying, high volatile 10% a month deal, don't wheel it. Okay? If you don't want to own it for half a year or more until that thing eventually recovers, stocks go up, it's a good thing. Okay. But they may not go up right away. They can stay down for a long period of time, potentially years. Okay. But we'll see. Yeah. I don't like this as an income trading only strategy without PM or span margin here, right? So if I'm going to do something like a McDonald's or Microsoft or Apple or somebody like that, I don't really want to trade this without PM. So without portfolio margin or doing futures using span margin, I don't like it in a Reg T account. You don't get enough good buying power use from owning the stock or the options without PM. I don't think it's worth it. Okay. Doesn't mean you can't do it, but I just don't personally like this without using it in a PM or using futures in a span margin type of account. Okay, I want to see my asset in a weekly uptrend where the 21 EMA is greater than the 50 at least, maybe even more than the 200. And that's my 50 EMA rule, that the underlying has to be trading above the 50 EMA on the daily. Okay. If it's below, that's a downtrend, and I don't think that's a good idea. All right. And an optional pulling back, but above the 21 EMA on the daily. This McDonald's trade's a little sketchy here, but it's close. Right. So how are we going to do this? Now, number one, I like to go about 12 to 30 days out. I'm not doing these weekly. I don't get far enough away. I'm a big chicken. I want more premium. The farther I go, the better. In fact, I would probably ideally like to see something that's 70 to 120 days out if I'm investing in it, which is where I would prefer to put this type of a trade, not in a trading account that just ties up all my money, because I'm a futures trader and I can make a ton more money trading options on futures and trading the 112 and strangles and all of that on futures. I can make a lot more money than I can on the wheel. Okay. So if I'm going to do the wheel, I want an account that's larger. I can put on longer trades, because anything longer than 60 to 90 days, anything longer than that is going to give you a much better return on your margin, because the implied volatility is going to be larger than the realized or an actual volatility, or the actual move. So the expected move is much higher farther out you get than the actual move tends to be, which is why I don't like trading 30, 45 days or less. Typically, I like trading 60, 90, 100 days out or more if I can. But if I'm going to do this potentially in a PM type of account and more of a trader style, I'll go shorter. If I'm doing it in an investing account, I will go longer. Right? I do like to sell around the 25 to 30 delta put, but I will also maybe look at some support here a bit just to see if that makes some sense. But I don't know that you have to, because support can be broken. I mean, it holds and holds until it doesn't. I like to get at least 25 to 30% annual percentage rate on my BP. So if I'm going to sell this thing, I'd like to get 20 to 30% return right off the bat. Okay? And then if the current APR is greater than the original APR when I put it on, and I have more than 25% of the trade left, I could potentially take this off early. So I don't need to hold and wait for assignment. If I'm already making money and I'm making a higher percent than I thought I was going to make originally, and I still have plenty of time left in this trade, let's just take the trade off and move on to something else. Okay, maybe we do it again in the same stock. Okay. And then selling calls when assigned. So if you get assigned, my rule is going to be that I'm going to sell around 25 to 30 delta above the assigned price if it's uptrending, or if the stock is downtrending, which it usually is when it's assigned, but again, it could flatten and start to go up. Okay, I will sell at the strike price if we're down or trending sideways. All right. So hopefully that makes a little sense. Let's take a quick look at a trading account. And let's jump into McDonald's here as a good example. I just picked this one out. If we looked at, I'm sorry, you know what? If we looked at the chart on McDonald's, here's the weekly chart. Now we are well above the 200. The 50 is above the 200. The 21's above the 200. The 9's above the, the 21. Even though it's pulling back a bit, which is fine. This thing's in a bit of an uptrend right now. So McDonald's has been in an uptrend on the weekly, and now it's pulling back to the 21. If we look over on the daily, we broke the 50, but we're back right at the 50. Remember, I wanted at least to be at the 50. It's technically right at the 50. That's okay. It's pulled back to the 21. It's above the 50. It's not exactly a perfect trade here, but it's not bad. This has had a nice pullback in an uptrend. I think this is a good, if you like McDonald's, okay. Well, if you like it at 300, you better sure as heck like it at 290, right? And then let's go to our trading platform. Okay, let's just go out. Let's go 45, and let's go 67 days on this thing. And we would pick something potentially around, maybe the 30 to 22 delta. Let's just do 22 delta here. Right? If we do the 22 delta, I don't know how this midpoint's going to work out in this account, but you can see this is going to pay us around 233 bucks using 4,000. Not really hitting my requirement for income here. And maybe I move it up to 330 bucks here on 4,800. Without PM or span, this trade's not really my cup of tea. Okay. Yes, you can make some money, 330 on this. Okay, that's not even 10%. It's not even like 8%. Okay. So I want something that's going to give me a better return. This McDonald's trade is not bad, but let's just say that this is okay and you want to do this. Okay. If I'm selling even at the 30 delta, I have a 72% chance, okay, that this won't go here in the next 67 days. Or so. If it does, I'll get assigned 280, and then I'll start wheeling my way out of it. Okay. But if I get assigned on 100 shares of this thing, okay, all right, it's going to cost me 14 grand here, and at 14 grand, I can start to now sell covered calls on this particular thing, okay, and maybe start to pull in about 500 bucks on that 13 grand. Which is about 4% or something like that. I'm not making a ton of money, but it's McDonald's. Maybe it's a high quality stock for you. I mean, you can pick a whole lot of different stocks. People might like Apple. I think AMD is one that people will potentially use a lot. Disney might be another one. Like Disney is a good one right now, but it's already off to the races. Boeing is down. And there's not a whole lot of beautiful setups on the wheel here. I just don't like it. What I do like is futures. Okay, so if I want to go trade some futures, let's take a look at ES as just an example. You know what? I would rather do oil. Okay, let's do this on oil. All right, oil, the chart on oil is pretty nice for the most part. Okay, the MAs are not exactly stacked, but they are above the 200. It's rising on the weekly. We've had a decent little pullback on the daily. I mean, I could still do something out here on oil, and somewhere around that 30 delta-ish or so here, I could sell the 72. Okay. Now, because it's futures and we have a 1,000 multiplier on this puppy, okay, I can take in 2160 using $7,000 in cash. Now we're talking. Okay. And because I'm trading futures, I'm probably even a little bit more chicken, and I'm probably closer to this 25 delta-ish thing here. Okay, let's go 70. We're currently at 77, so it'd have to drop 10% to get in there. I'm still taking in $1,500 using $6,000 in cash. Okay, 25% return on margin if we're assigned, and then I start wheeling that thing. And if I'm wheeling it, okay, if I would get assigned that one contract, okay, it's going to cost me 12 grand to hold the futures. Okay. And then I'd start selling something around the 30-ish delta, something like the 81 or something here. Okay. Or if we're in a downtrend, I won't go lower than where I'm assigned, but I could be selling something right at the money for, maybe 3,600 bucks or something like that. Still pretty good. Still pretty good amount of money to sell it there and get taken away. So anyway, I just want to give you some semblance of what I'm doing, but I typically like longer term when I'm doing these. I don't love the wheel. It's not my favorite strategy. Anything that caps your winnings, but you maximize the losses on it, doesn't sound like a good strategy to me. I think as a trader, it's not my favorite thing. As an investor, I think it's not a bad thing. I know there's plenty of people teaching this out there. I know there's a lot of people that love the wheel. I know there's a lot of people probably making nice money. Well, the markets have been in a great uptrend for quite a while, except for 2022 and a little bit at the end of last year. We're rip-roaring, through, or at the beginning of last year, we're rip-roaring through the markets. When the markets are moving up, you're making money, but you're capping your upside. Okay? If you're looking at some of these covered call type ETFs, like Tesla and stuff, you're down. The stock's dropping. You're getting distributions. The net asset value is eroding as you go. So the asset's dropping. You're not getting paid enough to offset the losses in your stock going down. If your stock keeps going down, you're in big trouble. Okay? And you can't stop the cycle without taking a bigger loss and wiping out all of your gains. Not my favorite thing, okay, but this is how I trade it. I hope this was helpful for you. If you decide you want to trade the wheel, more power to you. Good luck to you. Have some rules in place and really just look for something a little safer and a little smarter. Be smart with what you're doing. Okay. And in a couple days, I'm going to share how I like to really juice the wheel up a little bit more and make it a more exciting trade. Now I'll do something along these lines and I'll show you what I'm doing that's a little bit more unique and I think a little bit more valuable. All right. Everybody take care and I hope you enjoyed this video. Bye-bye.